Welcome to the Smart Property Investment Show. In this episode, we weigh up who's more on the money. Real estate agents who say everything from Sydney to Hobart is going to boom in 2016, or the doom and gloom economists who predict it's all about to fall apart. We also find out if investors are going to struggle to get loans in 2016 and some of the key mistakes buyers are making at the moment. All this and more coming up in the Smart Property Investment Show. Hi everyone, welcome to the Smart Property Investment Show. My name's Phil Tarrant. I'm the editor of Smart Property Investment. Today I've got a bit of a mixed podcast and I'm really looking forward to it. I've asked Troy Phillips in. He's the director of First Point, which is a mortgage financing company. And I've also got James Hall, or Jimbo as we call him. He's the head of mortgages and real estate here at Sterling Publishing. So I've asked these two guys to come in to have a chat about mortgages in the marketplace right now and what's happening. Say hello everyone.
How are you, Phil? Thanks for having me along.
Mate, it's good to see you, Troy. Jimbo, welcome.
Hi, Phil. How's things?
I've known Troy for
many years.
12, 13 years, yeah. I think. I met him in my first job as a journalist, actually. And he, at the time, was with the National Australia Bank. Troy's worked in mortgage financing for all of his life, I think. You started off in a bank branch, right?
I started off as a bank Johnny, so I've done everything from proof operator right through to running a small regional bank and a few other things along the way.
So what does First Point do now?
First Point's basically a mortgage lender and a mortgage broker. It's based in the southern parts of Sydney, but operates all over Sydney CBD and out to as far as Newcastle, down as far as Wollongong. And it's got a close association with the Macquarie Bank and Adelaide Bank Wholesale.
So the reason why I asked Troy in is that me and him, over the many years we've known each other, have had some pretty robust conversations around what's going on in mortgage. I appreciate Troy's frankness when it comes to the state of play in the market. And I know Jim works quite closely with Troy in a lot of the commentary via your publication, The Advisor. Mate, my question to you, Troy, is we've gone through a period right now, low interest rates, a booming property market. Most recently, APRA has decided to tighten the screws on mortgage lenders and everything seems to have stopped. Mate, what's going on?
I think they've got to take a bit of balance in between. If you take the real estate agent's view, everything's booming and you've got to look to other. They're always trying to find another state. I read recently Tasmania's on the boom. And if you take the economist's view, some of them, they're the bear that everything's going to fall apart and it's all going to go to doom and gloom. So there's got to be a bit of balance in between. Look, I think that there's a bit of a bias towards rates staying on hold and easing. I'm reading where they think there might be a rate reduction in June. I don't think that'll get passed on to the consumer in full. I think investment property is going to, banks are going to still remain pretty firm on investment property. I think they're pretty full on that sort of stuff. And they're probably taking advice from their internal economists, plus looking at the markets, globally and saying we want to slow that down. So I think that if you're an investor out there and you're carrying some hefty debt, or you think it might be time to lock some away, I think I'd be looking at some 3 and 5 year money now. I mean, you might not get the bottom of the market, but if you're in the long term, then I think I'd be looking at some 3 and 5 year fix for a portion of my portfolio.
Well, what are you seeing, Jim? The brokers you chat with, are they concerned? Are they, the brokers that mainly service investments? Obviously, there's always first home buyers in the marketplace, and that's sort of coming back a little bit because there's less pressure on property prices with less investors in the marketplace. But are brokers worried about their ability to service investors' financing at the moment?
I don't think they're worried about it, Phil. I think most brokers that I know, most good brokers out there, realise that investors can still get in loans for people who are in good situations that should be investing and have got the right finances to invest. And for those that were maybe running a little bit close to the wind, they're not getting settled. So I think most brokers understand it's really about responsible lending. So I think they see it as an opportunity as well to have a conversation with their clients. Yes, they might not be settling quite the same amount of deals, but look, I don't think many brokers would sleep very well knowing that they're settling loans for people that could run into a little bit of trouble. So who's walking in your door at the moment, mate? I know you got your HQ down in Cronulla. You got first home buyers coming in? A
lot of first home buyers that have had pre-approvals in place for a while. As the market sort of slowed a bit, they've jumped into that unit market. We've got a lot of upgraders that have come out of the unit market, and they're moving into their first home. I mean, but that market's getting really still pretty hot down there. I mean, I saw a property the other day. I would have said it would have gone for 1.4 million. Some people were going to auction. I went for 1.79 million. I was flabbergasted. So I'm still seeing a bit of heat there. But the advice I give a lot of people is, they save their deposit, they want to get in there, and they've got this stigma about we're renting. And I said, well, if you're renting and you're happy where you are, be smart about it. The idea with property is to buy the property, don't get sold the property. and that goes for investors as well. You've got to buy the property, you've got to do your research, and you've got to buy the property yourself and be comfortable with it. Don't get sold something because you think it's, you're reading the paper, you look at all the external market vibes, and someone who's a supposed expert pushes you into something, because that's when you're going to lose money, or you're going to be unhappy with the end result.
So the investors coming in that you guys are sorting out with finance, what sort of deposits are they bringing in? Are they sort of around the 80% mark? Are they 70%? Are they 90% lends? Where are they in that moment?
Look, most of them are 80% and below. A lot of them have got their own property, their own rock property, and these are people like, I'm talking people 30 to 35 that have got their own rock property. They've paid that down. They're using some equity in that. They've also got some money they've saved up, and they're not going into that mortgage insurance territory. The first home buyers are moving into that, above 80 in that mortgage insurance territory, but the investors are sticking below it, and I think the banks are happy with that. And they're mostly paying P&I, principal and interest, because they're getting a better deal. All the banks are actually pricing interest-only loans at a higher rate now, and the higher the LVR. So we're getting towards that risk-based pricing now, where if you're going to take a higher LVR and you're going to want to pay interest-only and spec a property, you're going to pay for it. And I think that's going to become more prevalent in the next 18 months.
Can you explain to our listeners what lender's mortgage insurance is, or LMI?
So lender's mortgage insurance is something that a lender takes out to insure them for a loss on a property. Now, in the past, lending over 80%, they'd have to put more capital away for a property, and they have to put more capital away for an investment property. The major four banks don't have to put as much away, hence they've been able to charge a lesser rate. It's been flagged to them that in the next couple of years they're going to be required to put more capital away. So hence that's the increase in investor property loans. What it allows someone to do, it allows someone to go and pay a premium to an insurer that will allow the bank to lend them money over 80%. Now, lender's mortgage insurance is actually a really good product. It's a hefty premium, but in a market that was moving, say, 4 or 5 years ago, I've seen some young people that work for me use lender's mortgage insurance to get into a property at 90 or 95% that they wouldn't have been able to get into previously. And they're looking back now, and they've made 40% plus gains on the property, so they're very happy with the result. And it's something that's sort of, it's something that's seen as being expensive. It's something in downtimes is seen as being, maybe a bit of a non-event. But I think in markets that are moving and you really want to get in, it's hard to save, 10, 15%, 20% for some people. So they've got to really get their head around lender's mortgage insurance, and the premium, they can generally borrow that as well. So you
can capitalise that.
You can capitalise the LMI up to a certain extent, even though it's a one-off fee. If they really believe in the property and they like where they're going, or they've got to get into a property, it's a must.
So it's a bit of just a price to play, really, is it?
It's another price to get into a property if you haven't got 20% saved.
And you think investors, by and large, understand how LMI can be an enabler to get into a property rather than it being a hindrance or a hurdle to actually buy? Because I know a lot of people get stuck and they go, I'm not paying that.
Sometimes you've got to swallow $15,000 to $18,000 in a fee, but it's part of the in cost. Sophisticated investors do. First-time investors probably don't get it. But if you believe in the property and you're going in with a 8-year plus plan, most of the people that have done their homework accept it and are willing to take it. They can use their cash for other, to reduce their non-deductible debt in any case. If
you're looking at a stable market or a market which is softening, which is what we're sort of entering right now, versus a hot market, say Sydney 4 years ago, LMI, it's something you've got to consider. If we're not going to get the same growth that we've been getting, would you sort of look to provide a bigger deposit up front and not pay LMI? Or how would that sort of change?
Depends. A lot of these people are doing these family pledges now where they'll take a guarantee of parents, and that will eliminate the need for LMI. That's a good product.
So do you see that a lot with younger investors coming in where their parents are willing to stick up their houses as collateral?
Yeah, a lot of them.
And how does that work? Can you explain to our listeners?
So if, a young couple looking to get into their first home, they've got mum and dad, they've paid their house off, or they've got a mortgage with plenty of equity into it, they can put up what they call a family guarantee, where the bank takes a second mortgage over their house and just uses that as make-weight security, which adds to the value of the property they're purchasing. It takes the LMI question out of the equation. So if you've got mum and dad or grandparents out there with a bit of equity in your property, Google the family pledge loans and take them through it.
This is a question for you, Jim. So do you reckon most brokers let their clients know that, or investors know that there is this thing, LMI, which means that they can borrow more?
Yeah, I think putting my my advisor hat on from a publication perspective, I think over the years, a number of brokers have sort of struggled to get their head around sort of clearly articulating LMI to their clients. I know a number of, or two of the players in this space have done quite a lot on the education front to try and educate brokers on the benefits. So I think those that understand it articulate it well. But but there is still quite a number of brokers out there that do sort of struggle, because it's, I guess, on top of the fees that you're paying for your loan, your mortgage repayments, to then go back and say, well, look, there's another fee. I think the stigma of the word insurance as well. I think in whatever industry you work in, it feels like it's an add-on, and I think from a buyer perspective, I hear the dreaded word insurance. Oh God, this means an extra cost, and without it being explained to me or the actual benefits of it, it can become a bit of a stumbling block. And just from over the years, that doesn't seem to have gone away a great deal. You'd probably agree, Troy.
Yeah, it's got a bit of a stigma attached. But as I said, I'm looking back over the last 5 and 6 years and some of the young people that work with us that have used it, and it's a good marketing tool. I mean, there's only 2 mortgage insurers in Australia now. It's not the sexiest market in the world, but it's it's something that you should, if you're not going to be able to save money in the next 2 or 3 years, it's something you've sort of got to have a look at and be willing to investigate and talk to your broker about, or to your lender about.
Investors have seen increases in their rates of sort of 0.5 or 5 basis points, etc. And you've reported on this quite a lot in your publication, Jim, about these rate increases and what it means for investors, but also how brokers can help articulate to the market. Troy, where I want to sort of take this conversation now is around how an investor should be looking to or consider their serviceability when it comes to investing in a property. So we've got interest rates at where they sit right now. You're saying that there's talk about rates coming down a little bit. There's other people talking about rates going up. But at all-time low, we've got plenty of people in the marketplace, lots of investors there. What would happen if rates went up 2%? What do you think would happen to market, and how can investors sort of plan for that?
I've thought about this. I think you should be looking at a buffer of 2.5% to 3%. If you're like someone who's got a goal of getting 50 properties and you're sailing close to the wind with $1 surplus, your strategy's flawed. I think now if you're an investor and you've got a 10-year strategy, you should be, as I said earlier, you should be locking some debt away. But you should always expect the unexpected. The Australian dollar a year and a half ago, people were travelling overseas, it was $1.05. Now it's like teetering at 68. Who would have thought that? People are heading to the Gold Coast and Noosa again because going to Hawaii, going to the US is too expensive. You've got to anticipate, if you're a sophisticated investor and you've got a fair bit of debt and you've got a fair few properties, which ones you can take a profit on. I always say you can never go broke taking a profit. Don't fall in love with your asset. Get rid of it. Pay some debt down and lock some debt away. Now is the best time to lock in some 3 and 5 year money.
So how do you do that?
Ring up your mortgage broker, ring up your lender, your bank, and ask them what the best deal they've got going on 3 year and 5 year fixed. Work out how much of your debt you want to lock away, because there's some really good variable deals out there.
So you can do a bit of...
You do a split loan, you'd have some variable and you'd have some fixed, but you're definitely going to lock some fixed away now. Don't quibble over 0.25, 0.3% at the end of the day on a fixed rate. If you've got it away and you can afford it, you're an investor. You've got property, you've got income, and also you want to make sure you've got some good tenants and you've got some good leases and your property's getting managed properly. It's a business you're running then when you've got 3 and 4 properties. If you're going in there thinking you're going to flick it and make good money on it, remember you've got capital gains tax and everything else, it's not a short-term play. That's for the casino or the stock market.
Property is a long-term play, so
Definitely.
You need to hold through cycles. And I know in your space, Jim, across real estate and mortgages, the quality and calibre of mortgage brokers today is much better than what it was 10 years ago. And you've seen that growth and evolution. Brokers now are held towards some pretty stringent regulations in terms of the way that they can offer advice to their clients. What's your sort of overall sentiments or perceptions towards mortgage brokers at the moment, and their sort of ability to deliver this firm, good quality advice to property investors?
Put simply, I think you'd be absolutely mad to be a property investor and not use a mortgage broker. There are many, many very good mortgage brokers out there, and it's easy to find a very good mortgage broker who has a lot of experience. A lot of mortgage brokers I know invest in property themselves, so they're not just talking about it from a finance perspective, they're talking to you as a fellow property investor. They can offer some sound advice around about not just finance, but property in general. Myself, I like to sleep easy at night. I've got a great mortgage broker that I trust is going to help me with my goals. Can maybe let me know a little bit more than I could probably find out going direct to a bank as well. So pure and simple, as a property investor, you'd be mad not to find a good mortgage broker.
And I always say, look, tipping on 50% of people have used a mortgage broker. If you don't like the one you've used, find someone else.
How do you find a good broker? What do you ask them? How do you know if a broker's a good broker as a property investor? How do you sort it out?
It's relationship driven. It's not. I think the word. It's like a professional. It's like your accountant or your solicitor. You got to find someone you can work with. You got to find someone you can grow old with. You got to find someone you trust. It's a feel thing. They've got to be well qualified. They've got to be able to, they've got to be able to walk the walk and talk the talk. But they've also got to have your best interests at heart. You're going to be able to pick that straight away. If you know you've got the wrong person, generally in any service industry, unless you feel sorry for them, you're better to punt them and find someone that's going to take you forward, not backwards.
And just to finish up, Troy, I want to have a quick chat about banks versus non-banks, or banks versus second-tier banks and non-banks. So we here at smartpropertyinvestment.com.au, we're pro-advice. We encourage people to use brokers, to use buyers agents, to go out there and find people who are better than what they are, to get good advice, good knowledge about investing in property. Now, back at the GFC, everyone flocked to the major banks because of the perception that they were strong and stable and their money was safe and there was guarantees and all this sort of stuff. First point, so you're a mortgage broker, but you also have your own
Funding,
loan.
Yep.
You have you get a first point loan.
Yep, 4.09% variable, which is probably one of the top five.
Good.
Yep, and you get a relationship behind it. So
if I'm an investor and I've got some non-banks lenders that I use to fund my property portfolio, and I'm really happy with them. Pepper's one of them. They're a good outfit. A lot of people still feel like they need to get a bank loan. So what would you say to investors around, say if one of your guys recommended a first point loan and it was the same as what you would get via Macquarie or Commonwealth Bank, does it matter the name on the loan? How do you work out whether the loan is the right loan? And do you need to go for brand or is it the actual product itself?
You want the product. You obviously want some solid internet banking. You want to know it's backed by, you're backed by a good business like a Macquarie or a Pepper. But these days the world's changed. I think that you've got a plethora of good lenders out there. You've got the four major banks. You've got a heap of credit unions that are doing a good job. You've got a lot of building societies that are out there doing a good job locally. So it's got to be a couple of things. It's got to be the region and the area you're in. If you're in an area up in far north Queensland, some of the small lenders up there have got a lot better feel, a bit of rhythm for the market up there than the big banks, and they're going to be a better option for you. You can build a relationship with them. You need a relationship when you're investing in property, whether it's with your broker and the lender as well. If you're in a big city, the major four banks cover those as well. But there's plenty of other small lenders like the Home Loans Limited, the First Points, the Peppers, the Bluestones, the Liberties, and a plethora of others that are worth having a look at for yourself. Take the best deal for yourself. I mean, you'd be silly not to have a look around and see what's working in your favour. But just one thing to leave the listeners with. I've been a very an unusual property investor. I've sort of got pretty strict in my ways, and I've always had a theory that do your research, always buy, don't get sold to. If you can't drive past it every now and again, even if it's a bit of a drive, have a think about it, because you're relying on agents, you're relying on tenants and other external sources to know that you're getting a good deal. So, I mean, I know a lot of people would probably laugh and scoff at that, but I don't see property as a share that you buy and you speculate. I don't think it's something you sit there and one day when you want to upsize, you go, oh, Jesus, I paid $350 for that. It's now worth $900. That's a pleasant surprise, and you've made a reasonable return on the way through, on the yield. Not a sensational one, but a reasonable one. So, Always buy a property and do your research. Don't get sold a property.
To finish up, Troy, I know you've bought property all your life and sold. We've spoken mainly around mortgage broking and securing finance today, and that's really draws on your skill set. But just a quick question to you as a property investor. What was the first property you bought?
First property I ever bought was a one-bedroom unit in Cronulla. That's all I could afford. I think it was in the early 90s, and I think I put part of it on bank card. I was working at Westpac, and I paid $117,000 for it. And I thought, $117,000. I mean, I'll never pay this off. And I knew it was serious. I was, just married. I knew it was serious when I put the bins out that I was the man in charge. But you couldn't swing a cat in it. And I thought, I'll never get $1 back on this. And that's when rates were 17%. And even though I was a bank officer, you start to pay a bit of your mortgage at 17%. So a Chinese meal at the local was a once a year treat. I sold it many years later, but I think I got about $375,000 for it. And I bought it in a really tough market with double-digit inflation, double-digit unemployment, no economic growth, and I sold it in a pretty tough market because I was upsizing and I wanted to pay some debt down. But that just goes to show you that was one of my first, and I did the conveyancing myself too. I bought a book. I couldn't even afford to pay the conveyancing, so I flung my way through that as well. But that's the first one I bought, and I've been very lucky. I bought some good properties. Bought some average ones.
Have you made any big mistakes?
Yeah, bought a house, bought a home once, walked in with my son when he was about 6 years old that had a pool, and I said, you like the pool, and loved it, and threw a silly offer in and probably paid a bit too much for a property, but I got out of it in the end and made some money. But, you know, it was a home, it wasn't an investment property, it was a home, so it was all right. A lot of good memories there. So, yeah, you make mistakes, but you've got to get past that. I always say, you know, you get 7 out of 10 right, you're well ahead of the curve.
Just to finish up, mate, if you go back in time and speak to the Troy Phillips in the early 90s when you bought your first house, knowing that what you know now and the fact that you've worked right across finance and property for all your professional life, what would you tell yourself?
I'd tell myself to respect debt, but don't be too scared of it. But it's easy when you know where you end up now, looking back, isn't it? But, you know, I always say to people, if you're not waking up at 4 a.m, sometimes looking at the ceiling going, what the hell's going on? You don't have enough money. I'd buy in quality areas. I'd probably stretch myself as far as I could. I'd buy in good areas and I'd buy quality. I wouldn't believe there's going to be a main road, or I wouldn't believe in speculation going through because you can get hold land banking. I'd never buy vacant land on spec because there's no value to it in local residential areas. I'd buy quality. I'd buy, you know, if I was buying, I'd buy good 2-bedroom units in beachside suburbs and suburbs with train lines and buses that rent well in Sydney. I like the Sydney market. I know it well. I can't get past that. I'd never buy a holiday house because you're stuck going there for the rest of your life and you've got to do the upkeep on it. I just know how that works. It doesn't work. Once it gets old and down, there's a better one down the road. Go and use that. Buy another investment property somewhere else and rent that out and go to another place for a holiday. Yeah, but steer clear of vacation. Just because you like having a holiday doesn't mean you should own property there.
Smart advice. Troy, thank you very much for coming in, mate. Really appreciate it. I'm sure all of our listeners will take a lot of that advice that you've given us today and go and use it well. Jim, mate, thanks for joining us again. You're always a welcome regular guest on the show. For all of our listeners, you can check out more on smartpropertyinvestment.com.au. You can also follow us on Facebook and Twitter if you want to keep up to date on a day-by-day basis of what we're up to. Guys, if you like the podcast, please give us a 5-star rating and leave us a review. We want to try and get as many people as possible listening to the Smart Property Investment Show. It is extremely popular. It's always rating high on the list of top podcasts, but let's keep pushing it forward, guys. Any questions you have or anything you'd like answered from myself or any of our guests, please contact me at editor@smartpropertyinvestment.com.au. Guys, say goodbye. Say to our listeners.
Thanks, Phil.
Thanks, Jim.
Thanks, no problem.
See ya. Bye.